My name is Dan. I'm the Customer Learning and Development Consultant here at RightCapital, and I'm excited to be here with you today for this presentation on the education module in RightCapital. So today we're going to be diving a little bit deeper into a case study I've put together related to education funding and putting together education funding proposals for clients. So just to preface, it's no real secret that we're living in a time when the cost of a college education, at least in America, is pretty much at an all-time high. While we all know that a well-rounded education can certainly pay dividends down the road, the prospect of saving and paying for that education, especially for folks with, multiple children that might be close in age, can be especially daunting. And that's where a tool like RightCapital's education module can really go a long way in helping these clients to put together a plan and to feel more prepared. So for those of you with clients that are planning either to go back to school themselves or to put their children or grandchildren through school, this can be a huge value add. It can help you more effectively navigate some of these potentially difficult conversations with clients surrounding education planning. So let's quickly dive into our agenda here before we switch over to RightCapital. We are going to start things off today by briefly touching on some settings and assumptions that might impact education costs within your client plans. We're then going to touch on some data entry specifically related to pre-college and college goals, as well as 529 accounts and 529 savings as well. We'll then dive a little deeper into the education module and start looking at creating some education funding proposals for clients. And then we'll wrap things up today by taking those education proposals and implementing those within the retirement analysis area. So I do want to mention quickly as I'm switching screens over to my RightCapital login, especially for those of you that might be new to our webinars here at RightCapital. First of all, these webinars are always recorded, and we do post the recordings of these webinars shortly after the fact within our Help Center. So if you do need to step away today at any point, you will be able to find a recording of today's presentation within our Help Center after the fact. And I can certainly show all of you where you can find that recording in just a minute here. I do want to also let everyone know that there will be a live Q&A component to today's presentation as well. So while I do have about 40 to 45 minutes of prepared content for you today, I will be sticking around until the top of the hour to answer as many of your questions as I can. So you should find a Q&A field in the Zoom webinar control panel on your screen. Feel free to write in with any questions that you might have as we're making our way through today, and I'll be here to help however I can. Here we are in my RightCapital Advisor portal. I do just want to quickly show everyone where you can find the recording of this presentation for those of you that might have to leave a little bit early. So in our Help Center, if you click into the chat bubble in the lower right and then click Search Our Help Center, you'll be able to find today's recording in the Webinars page on the far left. It will be listed under the Watch Past Webinars section at the bottom of this article. So you'll find that recording listed here in a couple hours later today, so you'll be able to watch this recording going forward if you'd like. All right, so with all that said, let's dive in for today. As I mentioned, we are going to start by touching on a couple of settings and assumptions to be aware of. So especially for those of you that might be a little bit newer to RightCapital, there are some assumptions that will impact the future cost of education goals that are entered into your client plans. So, most of the time when we're doing education planning with clients, those college goals or pre-college goals are usually happening at some point in the future. And when it comes to projecting those costs out into the future, we do have a dedicated inflation rate for that. And you can customize that either at a global level or at a client-specific level. So let's take a quick look here in the Assumptions tab of your Advisor portal, which is in the More menu here at the top of the page. In the Inflation section, you will find all of the different inflation rates that we use within the system in RightCapital. However, for our purposes today, we're going to be touching on this third one here, the education cost inflation rate. So the value that you see here, this 5%, this is the default rate that we use here in RightCapital. We do use historical context as our sort of default variable here for these inflation rates. So we're looking back at about 40 years or so of historical data. But of course, if you do want to see something different, feel free to adjust the inflation rate or or rather the education inflation rate, or any of these other rates to best suit your preferences within Right Capital. I mentioned that you can also tweak these values on a client by client basis as well. So once we dive into our client plan, I'll be sure to show everyone where you can customize this value at the household level within the client plan. Before moving on from this area, I do also want to mention that at the bottom of this page, these checkboxes sometimes fly under the radar a little bit, but these are certainly important when it comes to future dollars in Right Capital. You have the ability to pick and choose whether or not you want college goals happening in the future to inflate automatically between now and the start date of that goal. So you may notice here that I have all of these checked. I believe by default, it is just the goals that is checked here. So the other three, income, savings, and expenses, I believe are unchecked by default. But regardless, you have the ability to pick and choose if you want certain items in Right Capital to inflate between now and the start date of that item. So when it comes to something like college goals, assuming that the goals box is checked here, those will inflate by, at the moment, 5% each year to determine the future value, the future cost of those college goals. This is an idea that we'll come back around on in just a few minutes once we actually take a closer look at data entry for some of these education goals. One last thing to mention here, you also have the ability to choose whether or not you want adding children to a client plan to automatically generate a college goal. So this is actually a new preference that we've added somewhat recently. So this is something you'll find within the gear icon account tab within the preferences page in the middle here. There is a relatively new setting, like I mentioned, where you have the ability to choose when you add a child in the family section of a plan, do you want that to automatically create a college goal within the goals area of that plan? If so, you can leave this box checked here. This is checked by default within Right Capital. However, if you'd prefer for that to maybe not be the case, feel free to uncheck this box and then you'll have a little more control over when you're adding those college goals within your client plans. So just an additional preference that I wanted to make sure to highlight within this area. All right. So I do want to segue next into taking a closer look at the data entry process for these education goals. And I want to do this within a specific case study I've put together for today. So let's quickly pivot into our plan for Jesse and Leslie Aarons. So just to start things off here, to round out the settings and assumptions, portion of this presentation, I mentioned the ability to change the education cost inflation rate at the client specific level. So what we just looked at in the advisor portal is, of course, the global assumptions in Right Capital, and whatever you choose to enter there are what will be used as a starting point for all new client plans that you create. However, within each and every household, you can always click into the gear icon settings tab to update those values at a client level. So of course, that includes return assumptions and other methodology settings, but also in the other assumptions tab, you'll be able to customize that education inflation rate as well as the other inflation rates. So if you wanted to see something a little bit higher or a little bit lower for just this specific client household, just for Jesse and Leslie here, you'd have the ability to customize these on a client by client basis as well. We are going to stick with the default 5% for today. All right. So the next thing I want to look at here is adding education goals. Before we can start doing any education planning within the education module, we first need to actually enter the education goals themselves. And this is what serves as the foundation for everything else that we're going to be looking at here today. So this is something that can be done within the Profile Goals tab of each client plan. If you are still within the initial 6 steps of data entry for a client, this would be step 6 by default. I mentioned before that by default in Right Capital, whenever a child is added to the family section, so in this case, I've added 2 children, Emily and Michael. By default, that will automatically generate a college goal for each child within the goals area as well. So we can see here right off the bat, we already have a college goal for Emily and a college goal for Michael. Of course, you can always add college goals manually by clicking Add Goal in the upper right, hovering over Education, and then you'll find that college goal option right here. You can add college goals for grandchildren and other participants as well. So I always like to mention, in addition to adding college goals for children, you do have the ability to add those for other plan participants as well as for the clients themselves if they're planning to go back to school. So let's take a look here at one of these college goal cards. Let's open up our college goal here for Emily. We'll see that by default, we have a very specific setup here. And this is what you'll see whenever RightCapital automatically generates a college goal for a child within a plan. We can see that Emily is set as the student, so that's already in place. We can see that the start and end dates for this college goal are already set to Emily's age 18 to 21, reflecting a more traditional four-year college experience. And in terms of the cost, we also will set this to a national average, specifically for a public four-year in-state, on-campus college experience. So a bit of a mouthful there, but that's what you'll see by default in terms of the national average for these college goal cards. And we just, populate these values for you as a starting point when it comes to college goals. You are, of course, welcome to make changes to some of these selections, and you typically will most of the time. But I do find, especially when, advisors are working with younger clients, that they sometimes leave these be. Maybe you have a couple with very young kids, for example, and they know they want to account for an eventual college goal within that plan, but maybe they don't really have an idea yet of exactly what school they're planning for and so on. So in those cases, these default values can be a relatively safe starting point. I do want to talk a little bit more about some of these national averages as well. I did mention we have a couple additional averages to choose from here. In addition to that four-year in-state, on-campus national average, we have out-of-state on-campus, nonprofit four-year on-campus, two-year commuter national averages, and these will all result in different annual amounts here at the top. So something I want to mention is that these national averages are all based on published data from collegeboard.org. We update these numbers every single year within RightCapital. So this is currently all based on data from the 2024 academic year. So just something to consider. There is actually a link in our help center if you want to explore some of this data a bit more, which I can definitely show you in just a minute here. In addition to these national averages, we also have a specific college lookup tool that you can use as well. And this allows us to actually search for a specific college and pull in tuition figures. So at the top here, we can search for a school, maybe Marist, for example, which is my alma mater. We can click into Marist College here. We can see, again, based on the 2024 academic year, both the in-state and out-of-state tuition figures. We can see the breakdown between some of the different elements there, arriving at our total annual cost for that specific school. So if you do have clients who know exactly where they're planning to send an individual back to school, you do have the ability to pull those values into the college goal card here. Last thing I'll mention in regards to the specific college costs from this tool, these are all based on data from the Department of Education website. And just like the national averages, we update these each and every year. I do want to just very quickly showcase where you can find some more details on these averages and on these college costs if you're curious. Within our help center, you can always search for college goal or something along those lines, and you should find this education goals data entry card pretty much right away. And within this article, you will find some resources. If we scroll down just a bit here, you can find that collegeboard.org data I mentioned, as well as all the published Department of Ed data where we get all these numbers from. So feel free to take a look at either of these links to do a little more digging into those figures if you'd like. All right, so with all of that said, I always like to highlight the fact that you by no means have to use the national averages or even the specific college lookup tool. Just like everything else in RightCapital, you can always choose to customize the dollar amount and simply enter, the amount that you want to see, the gross amount of that college goal. So this allows you to be a little more specific here and reflect a specific dollar amount, that aligns more closely with exactly what you want to see within the plan. In addition to the cost and the timing of these goals, you also have the ability to specify the value of any scholarships or grants that the clients might be expecting, as well as any student borrowing. And all this will really do is reduce the net amount. So it will subtract these amounts from the annual amount we enter, or rather from the gross amount that we enter here. And then we can see the impact of that, at the bottom here within the net amount field. So it's essentially our way of indicating that, the client themselves won't be responsible for this portion of the costs. All right, so one quick side note here. I do see a question that came in asking why the timing isn't set from 18 to 22 for a four-year college. So I do want to address that quickly before moving on. Right Capital does primarily operate in annual cash flow years. And when we choose an individual's age as the start year for something, we're having that start at the beginning of that calendar year. And when we choose an end date for something, or rather an end age for something, this item will end at the end of that calendar year. So basically, this goal is starting at the beginning of the year that Emily turns 18 and stopping at the end of the year that she turns 21. And that does net out to a full 4 years in the cash flow projections, which we can actually take a look at to fully demonstrate this. So within the retirement cash flows tab, we'll be able to see those college goals occurring within the plan. So again, retirement cash flows, this will be within the summary table at the top here. And we can see, in the goals area, those education costs occurring. I believe I may have forgotten to hit save or refresh there. We do have Emily's college goal from 18 to 21, so let's save that. We also have a college goal for Michael, 18 to 21, so exact same setup here. Let's go ahead and click refresh. All right. Let's see here. I think I may have left something toggled on. Bear with me just a moment, folks, so we can get this looking the way we need it to in the cash flows here. We just remove the education strategy, which we will circle back to in just a few moments. Now, if we click back into our cash flows, we should see those full 4 years for each individual, which we do. So in the goals column of the cash outflows, we'll be able to click into the education area to see those separate 4-year college experiences for both Emily and Michael. So all that nets out to a full 4 cash flow years within the cash flow projections here. All right, so I am actually going to leave our cash flows open here. We will be taking another look at the cash flows in just a couple minutes. Before moving on from education goals, I do want to mention the fact that in addition to college goals, you do have the ability to add pre-college goals as well. So something like private high school, maybe. And the way that we would do that is very similar. You click add goal in the upper right, hover over education, and then you'll find a pre-college option as well. And the data entry here is mostly the same. The main difference is that we don't have those national averages or that college lookup tool to use, but we can still specify the student at the top here, the timing, which typically would be that student's age 14 to age 17 for something like a private high school. And of course, we can indicate the cost here as well as any scholarships or grants, just like before. So very similar when it comes to entering pre-college goals. And these will also pull into the education module along with the college goals, allowing you to factor in both pre-college and college when helping clients analyze the data and put together a strategy. All right, next up here, I want to talk a little bit about 529 savings. In addition to the actual college costs themselves, we know that you may also find yourself working with clients that have already started putting away for their child's future education. So I want to quickly look at adding existing 529 accounts into a plan and also entering 529 contributions and mapping those out into the future as well. So firstly, we can add those 529 accounts themselves within the profile net worth section. Again, this can also be done in the initial data entry during step 4, that net worth step. So we can see here, if we click into the investment section of this client's net worth, we do already have a 529 account here for Emily. And if we click into that, we can see some of those details here. We see the total balance, we see the cost basis, the asset allocation. So, let's go ahead and add another 529 plan here for Michael so that we can walk through this together. We'll start by clicking Add Account in the upper right. We'll add an investment account to our plan. And then the next step here would be to select in the account type menu the type of education savings account that we want. Something I want to mention here is that in addition to those 529s, you also can add UTMA or UGMA accounts as well as Coverdell ESAs. So if you want to be a little more specific there, you certainly can. However, I do want to also mention that in RightCapital, all three of these options, 529s, UTMAs and UGMAs, and those Coverdells, are all treated identically by the system from a planning perspective. And these will all get lumped together into a single account bucket, which we call the 529 bucket in the cash flows. So for the sake of simplicity and consistency here today, we will be sticking with just some 529 college savings plans. So let's go ahead and fill out the data entry here for Michael's 529. We can leave the owner set to Jesse for now, but for the beneficiary, we will certainly want to select Michael, our other child. To make this consistent maybe with what we've done for Emily's plan, we can say that the current balance is maybe 30,000, cost basis is 20,000, and then we can also choose how we want this to be allocated. So if we click into the asset allocation menu at the bottom, of course, you can always customize this in a more specific way if you'd like. But for our purposes here today, we're going to stick with a 60-40 model. So we'll quickly apply a moderate portfolio to use as the basis for the asset allocation here. I'm also going to name this account just to provide a little bit more clarity within the plan in terms of which account we're looking at here compared to our other 529 for Emily. So with all of that information entered here, we can go ahead and click Save. By adding these accounts to the client's net worth here, we will of course be able to see these on the client's current balance sheet, and these will also be mapped out into the future within those cash flow projections. In addition to 529 accounts, we can also add 529 contributions to a plan, and that can be done within the profile savings section. So this would be step 3 of that initial data entry process. In the savings section here, we can again see that I've already added 529 contributions for Emily. These clients are currently contributing $2,500 a year to Emily's 529 plan, and will continue to do so until the point that Emily starts college. So just like other types of savings, you can specify an annual increase as well if you'd like, in addition to, of course, the cost and the timing. So again, let's enter a 529 savings card for Michael as well to round things out here. Let's click Add Saving in the upper right. You'll find 529 right here on this first menu. Again, we can leave the owner set to Jesse to align with that 529 account that we added, but we will, of course, want to set Michael as the beneficiary here. We'll stick with those same contributions that we added for Emily, so $2,500 a year, and we'll have those contributions stop at Michael's age 18. Something that's important to note here in this area, in addition to showing contributions from the clients themselves within a plan, you also have the ability to show contributions from outside individuals. So in the owner field, in addition to the clients, you will find an individual outside of plan option. And that's a way to reflect a situation where someone else is helping out in terms of, contributing to this 529, maybe the children's grandparents, for example. So that's definitely a powerful thing to be able to add here. And I actually will leave this set here for now so that when we take another look at our cash flows, we can see where that's located when those contributions are coming in from outside of the plan. Again, we will want to name this so we can more easily tell these apart. And then, once we have this in place here, we can go ahead and click Save to add that to our plan. So with both of our 529 accounts and both of our 529 savings cards entered in the profile here, I do want to take another quick look at our cash flows so we can see how all of this is being mapped out. So let's refresh this page here. The first thing that I want to note is that 529 assets will automatically distribute to cover education goals within the cash flow projections, similar to how HSA assets will automatically distribute to cover medical expenses. We can see here that although it's not enough to fully fund all 4 years of college for each student, in the planned distribution column, we do see those 529s paying out automatically once each child's college goal begins. For pre-college goals, there would of course be a cap of 10,000 per year in 529 contributions, but for college goals like this, there is of course no limit. The second thing that's important to understand is that if the 529s are not enough to fully fund the education goals within the plan, RightCapital will still attempt to fund these goals by any means necessary. If clients have excess income during these years, we'll put that towards these goals first. And if not, we'll automatically dip into a client's investments to fund the shortfall, just like we would for other types of expenses and goals. So even if our 529s are underfunded, we will still attempt to fund these college goals. And this is something we'll explore in a bit more detail in just a bit here. So you can, file that one away for the time being. I want to mention that the planned savings column here in the summary table is where you'll see the 529 contributions themselves occurring, at least the contributions that the clients themselves are contributing. So we can see those contributions for Emily occurring here. We'll be able to see any outside 529 contributions within the invested asset table, specifically within the employer match and other column. So here we can see Michael's that we indicated were coming from an individual outside of the plan. So you can track both of those contributions here in the cash flow tables. And of course, last but not least, we can track the balances of those 529s as they grow and then eventually diminish within the accounts table in the cash flows. All right. So everything we've looked at thus far in our presentation today has been an important step in setting the stage for a well-rounded education analysis. Understanding how certain assumptions impact the projections, entering the actual college costs themselves, along with existing 529 accounts and future 529 contributions. And with all of this accounted for and mapped out accurately within the plan, now is where we can start to look beyond the data entry. So for those clients that do have concerns about being able to fully fund those education goals, now is where we can take a closer look at all of the data and start to figure out how much more they might need to save each year and what other changes they might want to consider to ensure that they can fully cover those costs. So here's where we're going to segue into the education module within RightCapital. And this is where we'll find the education funding analysis tool. So right away, we can identify some valuable information based on all of that data entry we just covered. Firstly, right off the bat, we can see the total projected education cost at the top of the screen here in future dollars for each of our individual students. So remember that these costs are being inflated by your education cost inflation rate each year. And by hovering our mouse over these charts, we can actually see that happening. We can see the increasing costs. We can see these slowly creeping up over the course of each student's 4-year college goal here. We can also see, based on the 529 balances and contributions that we've entered, what percentage of those college goals are currently able to be covered by those 529 assets in isolation. So we will be able to mix and match our funding sources here, which again, we'll get to in just a minute. But by default, what we see here in this area is how much of each student's education costs are able to be covered by just the 529 assets within the plan. So, we can quickly identify in a case like this that maybe we need to ramp up our savings a little bit when it comes to those 529s. In addition to these visuals for each student that are a bit more client-friendly, we also have in the Details tab in the upper right here, a cash flow breakdown. And here's where we can dig a little bit deeper and actually see, again, for each individual student, a summary of the projected education costs. Here's what we're looking at in terms of grants or scholarships, maybe. Here's the student borrowing that might be occurring. And of course, the net costs, 529 funding, other funding sources, and potentially any shortfall that might be occurring as well. So again, everything that we see here does hinge on all the data entry we touched on already. So, I always like to say that the quality of the data that we get out here is only as good as the quality of the data that we put in. So I can't stress enough the importance of that data entry that we covered already. We also have, in addition to the education cost summaries, a 529 summary for each student. And here's where we can actually see the portfolio return being generated within each student's 529, based on the way those are allocated, of course. And we can also see the contributions that we're making each year and ultimately the withdrawals that are, being distributed once those college goals begin within the plan. So even without making any changes yet in this tool, we already have a lot of valuable information to analyze the current state of a client's 529 assets within the context of the overall education costs for each child. All that said, analyzing a client's current situation is only the first step here when it comes to the education module. Once we've taken stock of where we are today, we can then utilize the action items at the bottom of each of our student tabs to start putting together an education funding proposal that is unique to each student. And for those of you that might be newer to RightCapital, the action items that we see here and elsewhere within the system are essentially plan variables that you can play around with to see the impact. This is where we can start to model different potential what-if scenarios and also dial in the details of our funding proposals. So let's walk through things here from top to bottom, left to right, so that we're all familiar with and comfortable with the options that we have here. The first few sliders that we see in the upper left here allow us to adjust the education costs themselves. So the values that are here as a starting point do feed in directly from each child's education goal. So we can see for Emily here, the education costs we entered along with any scholarships and student borrowing. By adjusting these items, we have the ability to model, a variety of different what if scenarios. What if this child goes to a school with maybe a slightly lower or slightly higher tuition, than what we entered in the profile? What if we, more aggressively pursue scholarships and grants? What if we have the student, take out more or less in student loans? So, all of these things we can manipulate to see the impact on the annual net education cost and by extension, our goal coverage as well. So let's revert this back to 30,000 just for now. In addition to the education costs, our second set of items allow us to adjust the 529 savings. So again, this information will feed in from the profile, so we see the current balance of Emily's 529 as it stands today, as well as those existing contributions that we entered into the savings area. So in addition to being able to make changes to our current contributions, we can also add additional contributions either annually or as a lump sum. So in a case like this, we can see pretty clearly here based on what these clients are currently contributing that they aren't saving quite enough to fully fund the college costs that we're anticipating. So we can use these items to back into a savings amount that gets us as close as possible to that 100% goal coverage. So let's dial in some numbers here. Because we do have some catching up to do, maybe we want to start with a lump sum. Let's enter a ballpark number here. We'll say $20,000. We'll click refresh in the upper right, and we can immediately see a pretty big jump in terms of goal coverage and how much we're able to fund. So that's a good first step here. In addition to that, maybe we also want to add an extra 10,000 per year. So let's enter 10,000 annual and then click refresh again to see where we're at. So we can see that now, we're quite a bit closer. Maybe we can even increase the annual savings a bit more, and hopefully that will get us where we need to be. And we're pretty much there. So this is maybe a little bit of a dramatic example. These clients do have quite a bit of catching up to do and not a lot of time to do it, but no matter what the client situation might be, we can back into the savings amounts that we're looking for to achieve, that 100% goal coverage that we're looking for. A quick side note about 529 savings. Obviously, we don't want to overfund the 529s in the plan by too much. So I do certainly see some advisors who prefer to stay, just under that 100% like this to make sure that we aren't contributing too much. But, in a case like this where we do have two children, I always like to highlight the fact that we will, of course, use each student's individual 529 plan for their individual college goals. However, once the older of the two children is done with school, if they do have anything left in their 529, we will automatically spill that over to the younger child and use that for their education, but only after the older child is done with school. So that is something that RightCapital will do automatically when there are multiple college goals for multiple children. So even if we do, slightly overfund Emily's 529 potentially, in a case like this, as long as we don't overfund Michael's 529, all of those assets will be used and will be in a good spot. All right. So our last two sliders on the right-hand side here are where we can make more sweeping changes to the way that this student's 529 funds are allocated, as well as what funding sources we want to use to fund their education. So if you'll remember, I allocated each of these 529s in the plan using moderate model portfolios. So these are both at a 60-40 split currently, and the portfolio return that they're generating is based on that allocation. But by, switching to a different model potentially, we can see the impact that that might have on our overall goal coverage. So just as a quick example, maybe we feel that these accounts are too conservative and that these clients might benefit from investing these, a bit more aggressively. If we switch this to something like an aggressive model, well, we can't really see the impact for Emily here since she's already at 100% coverage, but maybe if we were to do this for Michael and switch to a more aggressive portfolio, we'll see a small change to the goal coverage as a result of that. And, the way that these are allocated will change, the amount of 529 contributions potentially that we might need to make as well. So all these items are tied together. Of course, it is important rather to consider how risk averse your clients might be and how much time these 529s have to grow between now and when these college goals begin. But know that this is a variable that, you do have the ability to manipulate if you'd like. Lastly, we have our funding sources. So let's switch back to Emily here. So like I mentioned before, within the education module, what we're looking at to start is just the 529 assets for each student. And while there are, of course, tax benefits to be had there, you can choose to throw in other funding sources as well. So if you remember from before, when we looked at our cash flows, I mentioned that by default in the retirement plan projections, we will we will distribute the 529 assets first, but we will also dip into other investments if necessary to fully fund those education goals. And when that happens, RightCapital will fall back on a preset order of operations, which is determined by an important setting called the withdrawal sequence. So, for those of you that are longtime RightCapital users, you're likely already familiar with this setting. But for those of you that are a bit newer, I do want to take some time to pivot quickly into the plan settings here, just to explain that a little bit more. So in the gear icon settings methodology page, there is a setting on the left-hand side here called the withdrawal sequence. So when we have cash flow shortfalls in a plan, when a client's cash outflows are greater than their cash inflows in a given year, RightCapital will automatically dip into the client's assets to fund those shortfalls. And the withdrawal sequence here tells the system what assets to pull from first, second, and third. So by default, we'll pull from the client's taxable assets first, tax-deferred assets second, and tax-free assets last. And this setting, this order of operations, isn't just relevant for cash flow deficits caused by education goals. This applies to all cash flow deficits, regardless of the cause. So this is definitely an important setting in general in RightCapital. But circling back to our education module, what we have with the funding sources here is essentially a withdrawal sequence that is specific to just our education goals for this specific student. So it gives you a much finer level of control over which assets we want to use and in what order for Emily's college goal in particular. So if we wanted to be a bit more selective with what sources we're using, this allows us to accomplish that. A couple use cases, if you select 529 only and the 529s for the student are underfunded, something to consider is that we will not fund the remainder of this college goal if you leave that be. So there are times when you may not want that, but this can also be done intentionally. Maybe a client's grandparents, for example, are planning to pay for, a year or two of the client's college, and we are just targeting a couple years specifically. Maybe the clients themselves are the grandparents, and maybe they only want to see 2 years of goal coverage for a grandchild, perhaps. So there are use cases for that, of course. Another common practice might be to, slightly underfund the 529s, like I mentioned, just barely skate by under that 100% goal coverage, and then potentially, use taxable assets to, cover the rest. So you can use 529s and then have that last little bit be covered by taxable assets. So that's another common practice that I tend to see. Of course, if you choose the all resources option at the bottom here, this will function pretty much the same as the retirement plan projections. It'll use 529s first, any excess income second, followed by your chosen withdrawal sequence in the plan. So those are all options to choose from. So those are our options here. When it comes to the action items, depending on what we're looking for, we can mix and match these options to dial in, an individual funding proposal for each student to achieve the goal coverage that we're looking for. So we've been focusing a lot on Emily here. So let's dial in something for Michael to round things out. Let's again maybe start with a lump sum, maybe $20,000. Let's see where that gets us here. I brought us up to 64%. So let's maybe pump up the annual savings a little bit as well. And that gets us relatively close. So, again, let's maybe do what we did for Emily here and use 529s first and have the rest funded by taxable assets. And that should get us to that 100% goal coverage for both of the children within this plan. So if we take another look now at the cash flow details in the cash flow, or rather in the details tab here, we'll now see some differences in these values as a result of the specific changes that we've modeled. Firstly, the 529 summaries look different here. We can see the increased savings, the increased portfolio return for both Michael and for Emily. If we take a look at the education cost summary, we'll see that there are no longer any shortfalls. We can see exactly what's being funded by the client's 529s, and then what we're dipping into otherwise, in this case, taxable assets, to fund the remainder of those goals. So with that, we've now looked at data entry for all of the baseline information, college costs, and 529s. We've analyzed each child's current situation and all of the projected data. And now we've dialed in an education funding proposal for each child to make sure that we're saving enough to fully fund each child's college years while being as tax efficient as possible with those 529 assets. And while all of this is powerful and valuable in and of itself, there is one final step here that we can choose to take within this plan, which is taking these education funding proposals that we've modeled for Emily and for Michael and integrating those into the Monte Carlo and the cash flow projections in the retirement module. And this allows us to take our more specific education funding strategy and implement that within the broader context of a client's big picture retirement plan. And the way that we can do that is actually pretty quick and easy. Once we have a set of funding proposals that we're happy with and that the clients are happy with, we can navigate to the retirement analysis tool, scroll down to our action items at the bottom of the page, find our education strategy in the right-hand column here, and simply toggle on the education proposal. So once we click refresh here, we'll be taking all those changes that we've modeled in that education module, and we'll bring those over and make those a part of our proposed plan. And we can see the impacts of those education strategies on a client's probability of success and their median ending invested assets. So in that way, We can see how this strategy stands up against, the random market volatility being thrown at it as a result of the Monte Carlo simulation. We can directly compare our proposed plan with our education strategy to our current plan without that strategy to see, how those plans stack up when it comes to maybe invested assets over time, overall net worth, taxes paid, and so on. We can, see how our increased, 529 savings are looking. If we click into something like the savings tab, we'll be able to, take a look at those education account savings for our current year as well as savings over time. And we can also take a look at the impact on our retirement details as well in terms of income sources, withdrawal rate, etc. If we take another look at the retirement cash flows at this point, as long as we're making sure to look at the proposed plan here in the upper right, we'll be able to see the impact of our education strategy on our projections. So we'll be able to see those 529s paying out here again in the planned distribution column in the summary tab. We can see in this case now it is, mostly canceling out those college costs with the exception of that last little bit that we're funding with taxable assets. We can also click back into the accounts tab in the upper right to again, see the changes in terms of balance. So we can track those balances as they grow and then deplete. We can even take a look at the withdrawals occurring in total each year from their 529 bucket. So, this allows us to analyze all of the details there. And toggling back and forth between the proposed plan and the current plan in the upper right here makes it really easy to see the differences that those education funding proposals have on something like the 529 balances, for example. So for many advisors, this is the final piece of the puzzle when it comes to education planning, especially if you're going to be making an education funding proposal in addition to maybe some other recommendations. You have the ability to model those other changes, in addition to that education strategy and see the impact of all of that together on your proposed plan. All right, folks. So we are almost finished here. I do have one last thing to cover quickly before transitioning into the Q&A for today. This circles back to settings and assumptions to be aware of that might impact your education funding analysis. And this is a bit more situational, but something that advisors occasionally run into. Let's pivot back into the education module quickly. Something that advisors occasionally run into is a situation where maybe you're increasing the 529 savings in the action items here, but those increases are not having a noticeable impact on the goal coverage here at the top. So if that ever happens to you when you're using this module, if you're pumping up the annual savings or lump sum savings and you're not seeing the change you're expecting in terms of goal coverage, I want to quickly explain why that might happen and then show you a specific setting you can check that might help you work around that issue. So as a reminder, RightCapital is primarily a cash flow based planning tool. And while we do offer the ability to do goals based planning if you'd like, many of the additional modules in the system, including the education module, are cash flow based tools. And they do look to the client's cash flow projections, for each individual household as a foundation for what's possible. So for this specific example, the income that we see for that household plays an important role. Something that RightCapital does automatically when it comes to after-tax savings is cap those savings based on the amount of excess income that's available. And this typically comes up with taxable savings. If you have clients that are spending more than they're earning in a given year, and we try to enter something like maybe $10,000 in taxable savings, we actually won't see those savings occur if the clients don't have the available income, or rather, if they have cash flow deficits occurring within those years. But this same rule also applies to 529 savings. So if you were to try to enter 10,000 in 529 contributions, but clients are already spending every penny of income on their living expenses, taxes, and other savings, we won't see those 529 savings occur. So when that happens, you can pretty easily tell if that's the case by taking a quick look here in the summary tab of the cash flows. You'll be able to tell in the net flows column if those clients have excess income like we see in these years, or if they're, incurring cash flow deficits that require them to dip into their investments. However, there is a setting that you can check that will alleviate this in many cases. So let's take a quick look at that setting to round out the presentation today. In the gear icon settings tab, so back here in our methodology settings that we looked at before, if you scroll down closer to the bottom of this page, you will find a setting titled Use Taxable Accounts to Fund IRA and 529 Savings when current year cash flows are inadequate. And what this setting will do is, specifically for IRA, Roth IRA, and 529 savings, whenever we have situations like that where clients don't have available income to make those after-tax savings, we will instead dip into the client's taxable investments to fund those contributions. And I actually have this setting checked already within this plan. So, even in those cash flow years where the clients were, dipping into their investments due to cash flow deficits, we were still able to make those 529 savings by liquidating taxable assets. So this can be a helpful setting to check if you are wanting those 529 savings to occur. Even when clients are spending a bit more than they're earning, you're able to liquidate taxable investments to make those contributions if you'd like within your client plans.